Listen carefully, because what I'm about to tell you could change how much money you take home from Social Security for the rest of your life. Most retirees have no idea what just happened, and it could mean thousands of dollars more in your pocket every single year if you act smartly right now. The Social Security Administration just released the official 2026 Cost of Living Adjustment, COLA. And while most people are only focused on the 2.8% increase, what's buried in the fine print is far more important. Hidden inside that announcement are new rules and updates that could dramatically increase or quietly slash your lifetime benefits depending on how you respond. The average retiree will see their check go up by around $56 per month if they're receiving about $2,000 right now. That may not seem like a life-changing raise, but what's behind it absolutely is. Every single time these figures shift, your full retirement calculations change, and that's where people either come out far ahead or lose thousands without realizing it. The maximum Social Security benefit at full retirement age is climbing to $4,152 a month in 2026, nearly $50,000 a year, and many Americans can reach that with the right timing strategy. Now here's where it gets serious. In January 2025, President Biden signed the Social Security Fairness Act, a long-awaited reform that finally eliminated two of the harshest penalties that haunted public workers for decades: the Windfall Elimination Provision and the government pension offset. These rules had cut thousands from retirees' monthly checks, punishing teachers, firefighters, police officers, and other government workers who didn't pay directly into Social Security. Those penalties are gone. The SSA has already paid out more than $17 billion in back pay to over 3 million Americans, some receiving retroactive payments stretching back to early 2024. If you ever worked in a job that didn't contribute to Social Security and you have a pension, check your SSA account immediately, because there may be thousands waiting for you right now. Next, let's talk about a strategy that's quietly putting an extra $200,000 or more into couples' retirement plans, and it's completely legal, simple, and rarely used. This is all about coordination between spouses. Most couples file when it feels right, without realizing how much that timing affects both partners' lifetime income. Here's the smarter path. The lower-earning spouse files at full retirement age, usually 67, and begins collecting their benefit, while the higher earner waits. For every year, the higher earner delays filing past full retirement age up to age 70. Their benefit grows by 8% per year. That's not cumulative, that's a permanent annual increase. Waiting 3 years turns a $3,000 monthly check into roughly $3,720 for life. And here's why that matters. Once the higher earner finally claims benefits, the lower earner may switch to a spousal benefit if it's higher than their own. The spousal benefit maxes at 50% of the higher earner's full retirement age amount, not their delayed amount, but together. This strategy raises the couple's total income and creates stronger survivor protection. If the higher earner passes away, the surviving spouse keeps the higher of the two benefits permanently. If both file early at 62, those benefits are reduced for life, and the survivor gets stuck with a smaller check forever. Over 20 or 30 years, that difference can easily total hundreds of thousands of dollars. Too many people file early out of fear that Social Security is going broke. It's not. The trust fund may face shortfalls by the early 2030s, but payroll taxes would still fund about 77% of all benefits, even in a worst-case scenario. Filing early out of panic causes permanent reductions that can never be undone. Let's dig into the mistakes that quietly drain retirement income every single day. Mistake number 1. Believing your online estimate is guaranteed. That number assumes you'll keep earning your current salary until full retirement age. Retire even a year early, and your benefit drops because Social Security bases your payment on your highest 35 years of earnings. If you have fewer than 35 years, they fill the gaps with zeros. Every missing or low-earning year drags down your average, and therefore your benefit for life. Mistake number 2, ignoring the earnings test. If you collect benefits before full retirement age and still work, you can only earn up to $24,480 in 2026 without penalty. Earn more, and SSA withholds $1 for every $2 above the limit. Yes, you eventually get that money back in future payments, but it can destroy your short-term cash flow. Countless people have budgeted around their full check only to see half of it withheld because of part-time income. Mistake number 3. Not checking your earnings record. The SSA makes mistakes often. If an employer or the IRS misreports income, your benefit calculation drops. You must create a My Social Security account and review your record line by line. One retiree discovered 3 missing self-employment years. Fixing it raised his check by nearly $300 a month for life. That's $3,600 more each year, forever. Mistake number 4. Misunderstanding taxes on benefits. Up to 85% of your Social Security can be taxable if your provisional income adjusted gross income plus half your benefits plus tax-exempt interest exceeds $25,000, single, or $32,000, married. But there's good news. A 2025 tax law created a new senior deduction, increasing the standard deduction for those 65 and older through 2028. This can keep you below those thresholds, reducing or eliminating taxes on benefits. However, it's temporary, so your timing matters. If you're withdrawing heavily from an IRA or 401k while collecting Social Security, you could trigger unnecessary taxes. Many retirees benefit by delaying Social Security to age 70, using withdrawals earlier instead, and converting some IRA funds to Roth accounts before 70. Roth withdrawals aren't counted as taxable income, meaning they don't affect your benefit taxation. That's advanced planning, and it pays. But Social Security planning isn't just about when to file, it's about how your entire income structure fits together. Pensions, rental income, investments, and health all play roles. Done wrong, you can lose money every single month for the rest of your life. Done right, you can protect and grow your income stream with confidence. Now let's address something truly alarming: the overpayment recovery policy that changed in March 2025. If Social Security overpays you, even if it's their mistake, they can now withhold 50% of your monthly check until it's repaid. Before, the cap was 10%. Imagine living on $2,000 a month, and suddenly your check drops to $1,000 because of an error you didn't even cause. It's devastating, and it's happening right now to thousands of people. Some are being hit with repayment demands of $5,000, $10,000, even $15,000 or more. If you receive an overpayment notice, act immediately. You have 90 days to respond. Request a waiver if it wasn't your fault or repayment would cause financial hardship. Provide proof of your expenses and income if approved. The debt can be reduced or erased entirely. You can also request a payment plan to lower the withholding rate. Never ignore these letters. Silence means you automatically accept their decision. Adding to that pressure, retirees with old federal student loans are facing renewed Treasury Offset collections. The government can take up to 15% of your Social Security benefit for overdue student loans. Over 450,000 seniors are affected right now. If you're one of them, immediately contact the Department of Education to request an income-driven repayment plan or forgiveness program before deductions start. Finally, be aware of the tightened identity verification rules introduced in April 2025. You can no longer call SSA to make most changes like updating your bank account or address. You must either log in through your online portal or visit an office in person with ID. It's meant to improve security, but in reality, it's making life harder for older Americans who aren't tech-savvy. With fewer staff and longer wait times, issues are taking months to resolve. Your best protection is vigilance. Keep copies of every SSA notice, record all communications, and never delay responding to letters or payment changes. The system is more automated than ever and less forgiving. If you take anything from this message, let it be this: your retirement future is too important to leave to luck or fear. Review your records, understand your benefits, and plan strategically. You've worked your whole life for this. Don't let confusion, fear, or bureaucracy take away what you've earned. Stay informed, act quickly, and protect every dollar of your Social Security income because no one else will do it for you.